Welcome back to Cheddar, everyone. Today we continue our Idea of the Month partnership with Seeking Alpha, and joining us now is Sven Carlin, author at Seeking Alpha. Sven, it's a good day for you to join us because you're following this market volatility very closely, and this month we've already seen quite a bit, only 2 days in. So the big question I think a lot of our viewers have is now a time to buy?
I would say now it's definitely not the time to buy because the market simply underestimates the risk, and investing should be looked from a risk-reward perspective. And after a 9-year bull market, you should be sitting on huge gains, and you should take those gains, take the money, and enjoy your life without thinking of the risk in the markets.
How much more downside do you think there is here, Sven? It sounds like you're advising that people actually pull out of the markets and stay out of the markets. So how big do you expect this drop to be?
I just listened to Ray Dalio a few days ago, and he said that there is a 70% chance for a US recession in the next 2 years. So if you hit a recession, valuations are stretched, interest rates are going up. So there is so much risk, so the downside can be very, very large. And therefore, if you look at from what can be positive, what could be the reward, I wouldn't risk, I don't know, an upside of 10-20% or a dividend yield of 1.8% or a downside of 50%. So when you compare what can go wrong and what can go well, I certainly wouldn't take that bet from a general market perspective.
Sven, what do you think would be the cause of the next recession? When we have bulls come on the show, they continually say over and over again, hey, the fundamentals, even though we're seeing volatility, the fundamentals of this market haven't changed. They're still seeing strong earnings. We're seeing tailwinds from those tax cuts. And then we're seeing rising consumer confidence as well. So what's going to be the cause of that next recession?
Yes, but you have to look a little bit ahead than what has happened last quarter. And you as an investor have to look what will happen in the next 9 months, 12 months, year and a half. And higher interest rates are going to weigh very heavily on the companies that have doubled their debt levels in the last 9 years. So the debt level of corporations is double what it was 2007. So those higher interest rates will weigh on that. And suddenly a lot of investments that seemed okay with lower interest rates will not look that good. And therefore earnings will also be affected. And then the spiral starts. Unemployment goes higher, less spending, less revenues, less earnings. And then you have a normal cyclical economic recession that usually happens. This is one of the longest economic growth periods in history, so a market cycle, economic recession is bound to happen sooner or later. And I think the market isn't pricing that, and investors aren't ready for that.
Sven, you advised earlier in the segment that people withdraw their money and enjoy their lives. Now, do you suggest that they put that money in other investments, whether it's alternative assets, in real estate, something else, or you think they should just pull out that money and sit on that cash?
Now, if you are, let's say most people have their pension retirement funds. If you want to retire, just sit on that cash. Don't complicate your life. I think the stock market is up 220% in the last 9 years, so you should be sitting on great gains. You shouldn't risk what you have for something that might happen or not. So cash is definitely the safest option for the unsophisticated investor. In this late part of the economic cycle, there are hard assets, commodities that should do well. And I think Paul Tudor Jones said that we should be invested in commodities, hard assets, and cash. So those who don't want to risk cash, those who want a little bit more of sophistication and taking advantage of what will happen, then commodities and hard assets are the way to go.
Let's talk about how young people should think about investing in this type of market. Not those who are close to retirement, but those who are just beginning their careers. Of course, a lot of us who are that age, in our 20s and early 30s, lived through that Great Recession. Some of us even saw our parents lose quite a bit of money during that time. How should we be thinking about the next downturn?
Well, I think the young person should always think, okay, I'm just starting my investing life. I have a lot of margin to make errors. So you can invest, you can learn how to invest. And the key is, I think, for a young person that doesn't yet know a lot, dollar cost averaging. So you put a part of your salary every month into the stock market, and you make sure you put that part when there is a bear market or a downturn. So over the long term, even if the stock market goes down for the next 5 years, you will still be buying cheaper and cheaper equities, which will lead to higher returns in the long term. So you have to think from a long-term perspective and thinking, okay, I'm going to invest, I'm going to be a net saver for the next 20, 30 years. And that's the best way to approach the market and be in a winning situation for your financial life.
Right.
So it's good if the market goes up, okay. If the market goes down, you win again.
All right, a contrarian view here on this market. Sven Carlin, thank you for joining us. Sven is an author at Seeking Alpha. And for more information on Seeking Alpha's marketplace, you can visit seekingalpha.com/marketplace.